quarta sessione di oggi è dedicata agli investimenti sostenibili. La normativa europea richiederà ai consulenti finanziari di valutare le preferenze in tema ESG dei propri clienti. Come orientarsi in un'offerta che è sempre più ampia? Elizabeth Stewart, analista del team di ricerca sulla sostenibilità di Morningstar, ne discuterà con alcuni gestori. Elizabeth, a te la parola e l'introduzione dei tuoi ospiti.
Hello everyone, and thank you for tuning in. Joining us today we have Hannah Simmons, Head of Sustainability Strategy at Schroders. In this role, Hannah works in partnership with client-facing and product teams to deliver a cohesive set of investment options. Our other panelist is Sheila Turlag, Head of Global ESG Specialist at BMP Paribas. She's in charge of communicating with clients and externally on her team's innovative research, policy and investment stewardship and industry engagement activities. I'm Elizabeth Stewart and I am an ESG analyst on Morningstar's EMEA Sustainability team. And I'm going to hand over now to both of our panelists to give a short introduction of themselves, their teams, and the kind of work they do. So I'll start with you, Hannah.
Thank you very much, Elizabeth. As you mentioned in my introduction, I'm Hannah Simons and I'm part of the Sustainable Investment team at Schroders. And we've had a sustainable investment team for over 20 years. And so we've long recognised the importance of sustainability and ensuring that it is truly embedded into our investment processes. Today, we have a team of 22 of us, and we are, if you like, the sort of centre of knowledge for Schroders around sustainability. So our team is responsible for undertaking research into sustainable themes and trends. We're also responsible for developing tools to help our investors understand the impact that sustainability may have on their investments. And through time, we've launched a range of sustainable investment funds, and we continue to see a great focus in this area. And as our clients have asked for more sustainable investments, the next natural question is how we can report on the sustainability characteristics of their funds. And so hopefully today we'll get into some of those areas during the discussion.
Great, thanks Hannah. And Sheila.
Yes, hello, and thank you for your introduction. So I'm in what we call at BMP Paribas Asset Management, the Sustainability Center. So that's who I'm representing today. And our mission is to put sustainability at the heart of our strategy and the company as a whole. So more specifically, we're going to develop and implement sustainable policies, such as the Global Sustainability Strategy, our stewardship policy, voting policy. We carry out ESG research and support ESG integration. We're in charge of stewardship and external engagement activities. And we also look after ESG business and product development. Last but not least, the head of CSR of BNP PAM is also within the Sustainability Center, because we are looking to bring excellence to the companies in which we invest, but at the same time, we have to walk the talk as well. So hence the CSR, which is also integrated there. We also have a long history. So our first sustainable fund was launched in 2002. And since we've come a long way, I must say, since then, our global sustainability strategy was launched last March, so in 2019, bringing all the threads of sustainability together. And in that strategy, we talk about our what for us is sustainable investing. And basically, this is around 4 pillars. So the first pillar is going to be ESG integration. The second pillar is going to be stewardship, so voting and engagement. The third is responsible business conduct policy. And the fourth, which is probably the most differentiating, is our forward-looking perspective around what we call the 3 E's. So we have identified 3 critical preconditions for a more sustainable and inclusive economic system. And the first E is, of course, an energy transition to a low-carbon economy. The second, environmental sustainability. And then the third, equality and inclusive growth. So for us, together, these 3 E's represent the pathway to the economic sustainability that enables us as investors to safeguard long-term returns.
Fabulous. Thank you, Sheila. So should we dive right into some of the questions that we have lined up for today? And I'd like this panel to have sort of an educational feel, because we have 2 ESG experts on the panel. We want to take this opportunity to really pick your brains and have this sort of feel like a masterclass in ESG. So Sheila, I'd like to come to you first. In terms of education, how do you make yourselves available, your team available to investment managers, and how important is education that's coming from within your team, both within BNP Paribas and also externally?
Okay, well, I think this is a very important aspect of our activity and essential to achieving the goal I mentioned of putting sustainability at the heart of all we do. The Sustainability Center is central to the whole organization. It's kind of the hub around which sustainability is built. So we have to share this with the rest of the company, because within the global sustainability strategy I've already mentioned, the idea is not just to have a few products that are sustainable, but to really have all the products we have being sustainable. So prior to launching that strategy officially and making a press conference, we trained all our investment teams using 3 modules around sustainability. So what sustainability is in general, and then how we do it at BNP Paribas Asset Management. And we had, for each of these 3 modules, we had 3, we presented them 3 times. So this was to cover, of course, language preferences, but also time preferences, as we have teams in 3 different time zones. When we were looking to integrate ESG in all our strategies, we assigned 1 ESG analyst to each asset class to guide and help the different investment teams to integrate ESG into those strategies. Once they had done that, that was presented, the project of how this would occur was presented to the ESG Integration Validation Committee. So these were the first steps in bringing the teams closer together. Prior to that, the Sustainability Center was a group of analysts, and we serviced mainly just the SRI funds. So this was a way of getting to know, all the managers in the company. Shortly after that, we created what we call the ESG Champion Network. And this network is of, today there are more than 60 champions. At the beginning, the idea was to have at least 1 champion from each investment center, but we have 40 investment centers, so that means that there's more than 40 champions today. And what we want to do through them is that they be the first point of contact for the various investment teams before coming to the Sustainability Center, so that they already spread information from the Sustainability Center. And how do they do that? They base their knowledge sharing on monthly meetings we have with them, called, ESG Champion meetings, they're called, of course, where we bring them up to speed with what's happening in the Sustainability Center, but also what's happening with sustainability in the world. And that way they can already have a good grounding. And more than that, because I think our education is very important, but it's also important that they have more assurance by following external certifications. So, for example, the CFA does a very good ESG course. There's also the FS CESGA, the PRI does a couple of courses. So as a champion, you are obliged to do one of these courses. And of course, we never refuse if somebody who is not a champion wants to pass the course. So finally, the other moment of real communion between our two teams has been during the revamping of our ESG methodology, when together with our quant research group, the ESG the Sustainability Center and investments, we got together to set up this methodology, because after all, they're the ones using it. So it's important that they have their say in how it's done. So all this to say that we work very closely with them on all aspects of sustainability, and they know us well enough that they know who to come and get information from, whether it's around the methodology or information on a particular company, for example.
Thank you. That's great. I'm going to come to you, Hannah. As ESG takes more of a center stage and more people will be called upon to be sort of experts in ESG, do you have, it's going to be a learning curve for everyone, I think. Do you have any advice for advisors who are just starting to have conversations with their clients, and then again, up a level for those who might be more advanced?
Thanks, Elizabeth. And you're quite right that this is quite a sort of steep learning curve that many individuals will be needing to go on. And as clients seek to express their preferences and look to advisors to support them in being able to actually invest sustainably, the first part of that journey is really enabling the investment advisors to actually ask really good questions to their clients. Firstly, to understand more about the client's sustainability preferences, and also then obviously to be able to very clearly record what those preferences are and identify potential investment funds that seek to meet the needs of the clients. It's critical that this process doesn't become a box ticking exercise. The advisors must go into a lot more detail to really understand those preferences. So we start about thinking about stage one of that piece, which is about how you actually understand or ascertain the sustainability preferences that a client might have. And I think the first part of that is really making sure that you actually embed it in a holistic view of what the client is trying to do. So essentially really exploring their investment needs and desires broadly, and making sure that sustainability is part of that discussion, rather than a sort of discussion on your broad needs and objectives and then adding in a series of questions that then say, okay, we've done that, now we need to look at sustainability. So making sure it's a holistic overarching approach that truly gets to the heart of what is the client trying to actually do. And I think one of the ways that you can do that is by really starting out and exploring with the client the breadth of ways in which a client can invest, and thinking about that sustainability spectrum, where at one end there's a much greater focus on the financial benefits or the financial outcome that a client is seeking to achieve, and at the other end a focus much more on the social impact that may come as a result of their investment approach. And basically by identifying that spectrum and then asking those questions, you can tease out where a client sits along that spectrum. So the type of questions that an investment advisor might be asking of their client are things like, do you want to maximize your opportunity set? Do you want to focus on companies that are perhaps at the forefront of sustainability innovation? Actually, are you seeking to donate to good causes? By exploring those types of questions, then you can understand where the client sits on that spectrum. So that's part one. That's really about understanding what it is the client is setting out to do, or how they're seeking to invest. The second part is to then undertake the research into all of the investment funds that are out there to identify the funds that meet the needs of the client. And again, in the same way, there's that spectrum of approaches that a client can use to invest. There's also clearly a spectrum of different approaches to sustainability. And we heard a little bit about that spectrum from Sheila already. But again, thinking about is a client looking to embed sustainability really from a financial risk perspective? So that's more of the ESG integration end of the spectrum. Or actually, are they looking to have a much more meaningful impact with their investment and perhaps focus only on investments that or target very specific social impact outcomes? So again, you explore first of all what the client preferences are. Secondly, explore that range of sustainability types of funds to identify what might be most appropriate. I've got a simple, what I think is quite a simple way of summarizing all of that. And I summarize that in the acronym EAST. So make it easy. I do think it's helpful, and we see some evidence coming through, particularly from defined contribution plans. Make it easy by having a default, and make it really attractive. Help investors, help those end investors understand and have that sort of civic sense of duty. Socialize this, make sure that the end investor is talking to their family about what they're trying to achieve, what their objectives are. And finally, make it feel really timely. Make people understand that this impact can happen immediately, that it's not just future generations or in 2050, that you can have that impact today.
Yeah, that's really, really helpful. I think people are going to find that a really good jumping off point. And I'm going to stay with you on this because as ESG becomes this, huge piece in investment and it takes center stage, we're also seeing the issue of green or impact washing. And something that is coming in to potentially tackle that are a slew of new regulations. So that's the EU Action Plan on Sustainable Finance. What do you think? Are these the solution to this greenwashing? How do you think these are going to offer help, or is this another taxonomy that is just going to add to confusion? Have we lost Hannah? Can you hear me?
Hi, sorry, I did lose you for a second. You're back now, Elizabeth. So I lost you as you said taxonomy, and then I lost you.
Sorry about that. Yeah, so essentially I was just asking, do we think the taxonomy is going to help or hinder the amount of greenwashing that we're seeing in the industry at the moment?
Thank you very much. I definitely think it's going to be part of the solution. I think with all regulations, we must avoid it becoming a box ticking exercise. But the essence of the regulations around, if you like, supporting particularly for clients enhanced disclosures, Schroders is fully supportive of all of those moves that enhance transparency and help support clients and end investors in really understanding what it is that is happening within an investment fund, and therefore how it seeks to meet the needs of the clients. So we definitely think the regulations are part of the solution, especially those that enhance the requirements. And one of the things, that enhance the disclosures. One of the things that we truly think is important about the new regulations is the fact that actually it moves to embed and make ESG integration mandatory. And that's something that Schroders has been implementing in its own business over the last few years. So really truly being able to quantify how sustainability is embedded in our investment processes and the impact that it has on our investment decision making. It's incredibly important that our clients, the end investors, really understand and receive the information that they need to make, firstly, those informed decisions about whether or not this is the right investment fund for them, but also importantly, on an ongoing basis, provides that information, those disclosures that really help them understand how sustainability has been embedded into an investment process. And I mentioned we definitely need to avoid this becoming a box ticking exercise. So that information needs to be really clear. It needs to allow comparisons, so that, you know, if a client is looking at two funds, that they can compare across those two. That's also going to be a critical part of that enhanced transparency for individuals.
Thank you very much. And I'm going to give same question, the right reply to Sheila. What's the BMP Paribas view of the new regulation, and do you think there's any challenges that that's going to pose to the industry?
Well, I think if we look at the new taxonomy, it's good because it's providing us with a consistent framework, and it defines a common language relating to all sustainable financial products. And so this means that well, one of its aims is really to end greenwashing, and I think that is that is already a great thing as it is. And for us as an industry, it's going to help us to drive capital towards the environmental objectives and grow the clean economy of the future. So what's unique as well with the taxonomy in any case is that it's consistent with the EU environmental goals. So this includes the intermediate targets and a procurement plan for Europe to achieve carbon neutrality by 2050. So it really gives us a kind of a book, a dictionary, a book that we can follow, a roadmap. In parallel, we have the EU Action Plan on Sustainable Finance, which includes measures to strengthen the governance of companies in the area of sustainability. So the recently agreed recovery stimulus plan will also reinforce this trend because, with public support from the EU and in many of the regions coming with green strings attached, in return for this support, companies are expected to strengthen their governance structure and their sustainability capabilities. So we see this as a great opportunity to enshrine long-termism in the way that companies work. And it emphasizes the importance of ensuring, returns to long-term stakeholders, while at the same time not causing adverse impacts to other stakeholders. To long-term shareholders, while at the same time not causing impacts to other stakeholders. As for the challenges, I think the biggest one will be the conditions attached to the stimulus. Policymakers, they can implement recovery packages that can either act as a catalyst for change, setting companies on the right transition pathway, or they can lock in their unsustainable business models, and that will be wasting taxpayers' money.
I'm going to stay with you, Sheila, and speaking of long-term impact, have you seen or have you sort of decided upon what the revelations are to come out of the COVID-19 global pandemic crisis that you will be taking forward, and what has your team learned from that?
Well, I think that what we can take as some lessons from the crisis is that it has stressed the importance of the S and the G of ESG in terms of long-term value creation. There are a number of ESG issues that can be linked to COVID-19, and for example, healthcare access and affordability, crisis management, labor practices, employee health and safety, and then of course supply chain, where their location is, how they're managed. So those are some things which are really, have jumped out at us. And then regarding stewardship and proxy voting, the crisis has put the emphasis on the need for shareholders to encourage financial stability and sustainability in business models beyond just, be good at governance when they talk to companies. And we believe this crisis has actually led to opportunities, mainly in healthcare, in digitalization, and of course the energy transition. It's kind of been a catalyst to make things go more quickly on those three in those three areas and how they develop. But there may also be companies who will be more at risk, because if they're not proactively finding solutions to societal issues, they may not be able to produce sustainable returns in the long run. So those are the ones we have to watch out for.
And coming to you, Hannah, on the same question, what do you think Schroders have gleaned is the fallout from COVID-19 and what it means for corporates going forward?
Thanks, Elizabeth. We actually in the summer wrote a paper on this exact topic, and many of the themes that Sheila just introduced were actually the foundation of what we identified as 6 ways in which the corporate environment would need to change in a post-COVID world. We've long recognised that there are a number of forces and challenges that will cause significant disruption to companies, and we've written about this over the past few years in some work that we titled The Inescapable Truths. And COVID, I think, has really put the spotlight on a number of these areas. So as I mentioned, Sheila already highlighted a number of these points. So it's great to see that commonality between our 2 organizations. But we identified the fact that, companies that are able to navigate that relationship that they have with all of their stakeholders around the social contract that they've written would in the long term lead to significant outperformance. We looked at the preparedness for companies and the importance of being prepared for the unexpected. We do expect government regulation, and therefore how will companies respond to that? That point that Sheila raised, which I think is incredibly important, about how companies protect their employees both through COVID and also in the longer term, so particularly around some of those health benefits and ensuring that individuals have access to those. Supply chains coming under pressure, and making sure that companies really understand how their supply chain works and how they can deal with disruption. And the final element being really around the role of technology. And through the COVID crisis, we saw, if you like, an escalation of some of the global trends that we'd already seen, and an enhancement of people using technology, and we being prepared, making sure that you have the right levels of data security to deal with that very quick transition was also an area of focus for us. So that's some of the research we did. I wanted to highlight, if I may, a couple of the engagements that we're involved in during the COVID crisis, and really recognising that we needed to be able to both support the companies in which we invest. So our CEO wrote an open letter that was published in the FT. We also wrote to the CEOs of UK companies to reinforce the support that Schroders was offering through this period, and the importance of management looking to the long term and supporting their employees through the COVID crisis. We also undertook specific engagements to identify some of the challenges that had been thrown up as a result of COVID. So we engaged heavily with US meat processing companies where there were big impacts in their supply chain. We participated in a collaborative engagement in the Middle East around modern slavery and bonded labour, some of the challenges that were coming up because jobs in things like construction and hospitality were very quickly halted, and the impact that that was having on individuals that have moved to those countries. And we also participated in what I thought was some really interesting research on mental health, where we wrote to the FTSE 100 companies and asked about the actions that management have taken. And the results so far have been really pleasing, with very significant levels of CEO and senior management commitment to ensuring appropriate training for line managers operating in a remote working world, ensuring the introduction of flexible working practices. And we also asked about the extent to which performance appraisals and support systems have been put in place to support individuals through the COVID crisis. We've got some really encouraging data points around the introduction of training and flexible working. One area that I think we need to do a little more on, and perhaps as we get towards the end of the year, we would see an uptake in this, is the focus, or up to now, the lack of focus around incorporating mental health and the pandemic crisis into performance appraisals.
Thank you very much, Hannah. Speaking of engagement, I'd like to come to Sheila on the subject of engagement versus divestment. What do you think the importance of having a watch list is, and what does this look like in practice? And for the benefit of anyone who might know, could you please also define what a watch list is?
Well, I would say that our preferred mode of intervention is always to engage with companies. But there are certain circumstances where engagement will just not be productive. So this can be for reputational reasons if there's something quite terrible going on in a company. But other typical examples might be with a tobacco company or a pure thermal coal mining company to engage, to tell them to stop their activity. Well, that's, it's not going to be productive. So in our responsible business conduct policy, we have a number of sector-specific policies and also norms-based screening around the United Nations Global Compact and the OECD guidelines for multinational enterprises. So we establish lists which are updated twice a year. And within these lists, we have two types. So one is for exclusions, so companies that nobody can invest in. And the others are companies that we are going to put on our watch list. So concerning this watch list, as the name states, we're watching them. So these are either companies that have recently been excluded and maybe we're putting on the watch list because we think they should, we don't want to exclude them anymore, but we're not sufficiently confident that we can put them on freely available for all. Or there are companies that may be excluded at a later date because we are, as I said, currently monitoring them. So this can be for global compact reasons. This can also be because they are, if we given our coal policy, they are not exactly in line, but they make promises which mean that they will be in line soon. So again, they're companies that we will be monitoring. So as mentioned just now, none of the managers are allowed to invest in the excluded companies, and those that are on the watch list are excluded from our pure SRI funds, but they may be invested in by other funds or strategies.
Thank you. And same question to you, Hannah. Can you speak as well on the merits of engagement versus divestment, especially when it comes to dealing with poorly performing companies with regards to ESG?
Divestment is definitely an option, and it's something that we consider, and in the past we have implemented in some of our portfolios. But we do truly believe in engagement and having that, if you like, dialogue and then very detailed conversations with management to firstly understand some of their practices, and then secondly, once we have that insight into what it is the company is doing, then to explore and use our influence to encourage that transition to more sustainable business practices. So it's very much a sort of focus on identifying very core objectives, and whenever we have an engagement with a company, we specify that objective, and then we have the engagement with the company, and then we can identify what the outcome is. So it's very clear and documented so that we can evidence the engagement through time. That also allows us, where we aren't seeing the action that we might expect, to be able to identify where companies are falling short. And we have a very clear escalation process that allows us, if you like, to on day one identify what the goal of the engagement is, and then if we aren't seeing the action, we might perhaps speak to a broader range of individuals at the company. So we might escalate within the company, we might talk to the board directors as well. And again, if we aren't seeing the changes that we need, we can also use our voting voice to express dissatisfaction. And then finally, we may consider divestment. So it's an engagement policy helps identify where we are on that escalation journey, and divestment is the sort of last port of call for us, but hopefully through all of the other steps we'll be able to seek the changes that we're looking to for the company to implement.
Thank you, Hannah. Changing tack slightly now a little bit and getting a little bit more technical, not too technical. Sheila, at the top of the hour, you mentioned each asset class receiving its own expert within your team. Can you explain how the nuance appears between asset classes in ESG ratings and how ESG integration is tailored sort of fund to fund and between asset classes?
Yes, of course. At the Sustainability Center, we provide scores on more than 12,000 issuers. So the score is on the issuer itself. It doesn't matter whether it's a bond or an equity issue. It's really the issuer who's scored. And what we did when we went through this exercise was to establish general ESG integration guidelines, again with our investment managers, but of course with a lot of influence from the Sustainability Center. And some of the broad guidelines include, for example, only investing in ESG rated listed companies, doing a due diligence on non-listed entities, engaging with the worst performers on their weaknesses, and then divesting when there's no progress on the engagement. But for each strategy, the particulars of these broad themes, such as at what level is a company considered to be the worst, or how long an engagement should last before results are expected, these were adapted to each strategy. So there's really, general principles. And then, for example, if we look at concentrated equity portfolios in Europe, the ESG component is going to be one of several aspects that the managers are going to look at to decide whether or not to invest in a company. The managers may require more research when the companies are in the lowest quartile, for example, in terms of ratings. In a best-in-class SRI fund, the manager is going to exclude automatically the bottom three deciles in terms of score. So what is common, however, for all strategies is that we are going to aim, the managers are going to aim to have a higher average ESG score than that of their benchmark, and of course, as well, a smaller carbon footprint than that of the benchmark. So it's really, each strategy has their own way of integrating, but it's nevertheless under a common heading of how it's done.
Thank you, Sheila. And Hannah, please forgive me, but I'm about to ask you to give us a brief economics lesson. Can you speak about valuations and whether or not there is an ESG bubble, i.e. are stocks with strong ESG performance, are they priced too high today?
Elizabeth, that's definitely one of the things that could happen. And in fact, if we look in the last few months and what's happened to the performance of companies that sit within sustainable investment funds, they have performed incredibly well compared to traditional benchmarks. And we see that evidence from some research that Morgan Stanley have done, looking at over 11,000 mutual funds that invest in a sustainable way. So as more money flows into sustainable investment funds, you could see more money flowing into, if you like, a smaller universe of companies, which could fuel that valuation bubble that you identified. So one of the jobs of an investment manager is to seek those investments where we still feel that there is that valuation upside. And by investing in a very broad range of investments, you can actually seek that. So it's not just about investing in the most sustainable companies today, but identifying those companies that are on a transition or a journey to improve their own sustainability sustainability characteristics. And that will allow investors to see their own valuation gains through time. So yes, you could see that bubble, but it is about identifying the companies today that you feel will go on and benefit from being more sustainable.
Great, thank you very much. Lastly, I just want to go a little bit more zoomed in, and I want to talk about thematic products. So we at Morningstar, we've identified in Q3, in a couple of quarterly reports that we published recently, we've seen a real proliferation this quarter in thematic products. So we've seen things that are Paris aligned, a lot of green bonds coming out in Europe. And one thing that I would like Sheila to talk about is we see that BNP Paribas have brought out an ocean-focused fund, a blue economy fund. Can you explain to us what is the blue economy and what is the investment opportunity here? I think a lot of people may think about ocean health and just think about cleaning up plastic out of the ocean. What else is there to invest in?
Well, let's start with the definition by the World Bank on the blue economy. I think that'll set the scene. So the blue economy is the sustainable use of ocean resources for economic growth, improved livelihoods and jobs, and ocean ecosystem health. Because the oceans aren't just a source of livelihood and jobs, they also underpin economic growth and, super importantly, regulate the climate. Today, according to the OECD, oceans contribute USD 1.5 trillion every year to the global economy. So that is already huge. It's as if they were, the seventh economy of the world. And this is set to rise to over 3 trillion by 2030. So that's already to tell you that, what's going on around the blue economy. Now, the main challenges to the blue economy, of course, are to preserve the resources of the ocean ecosystems, because we depend on them, and also to reduce the human impact on the environment. I think we all know our SDGs by heart. Number 14 is life below water. So the United Nations has also made this, one of its sustainable development goals. So this fund is actually an ETF, and it aims to finance companies promoting the sustainable development of the blue economy. So that is related to marine and ocean economy. And also these companies should follow the best practices in terms of resource management and preservation of the oceans. So to make it a bit more concrete, the types of activities that the fund will be investing in, so we call them clusters because they're not necessarily all in the same sector. We're going to look at coastal livelihoods. So there you could see companies that make coastal protection. You're going to have energy and resources, and that's, for example, that would be an offshore wind farm. Fish and seafood, so they're, aquaculture companies, for example. Then there's pollution reduction, that's another cluster, and there we might see environmental service companies. And finally, we have the shipping lanes, because, the 80% of our goods exchanged are, traveling by maritime transport. So in the shipping lanes, we might see equipment for ships. So those are the basic arguments for this fund.
Great, thank you very much. And speaking of innovation and creativity, we've seen many of our major fund houses ramping up their creativity and what they offer in addition and what they offer as a value add. Hannah, in terms of Schroders, can you explain to us what Schroders is doing around ESG impact measurement as a value add and as being kind of creative and innovative in that space?
Thank you. Yes, this is one of the areas that I mentioned right at the beginning, that as more clients seek to invest sustainably, being able to provide that transparent reporting to help clients understand the sustainability of their investments and the impact that their investments have is clearly a critical part of supporting them. And so at Schroders, through time, we have developed a number of tools that are used by our investors to support them in understanding the sustainability characteristics of different companies. Those same tools that are used by our investors can also be very helpful in providing some of that reporting to our clients. So we've developed a toolkit that we call Impact IQ that houses a number of our investment tools. And it would take all afternoon to explain all of the tools, but I thought I would just highlight a couple of the areas that we're trying to capture through the reporting to really help clients understand what's going on in their investments. So firstly, we've developed a tool that places, if you like, a pound value on the social impact that a company has on society. So we're identifying various activities that companies are involved in and identifying what is their social cost or benefit, and then saying, okay, what is the extent to which your portfolio is involved in things that are beneficial to society or costly to society. So some of the things that are benefits to society are things like where companies invest in training that improve the productivity and knowledge and understanding of their workforce, or charitable donations, or innovation that drives technological development. So these elements bring benefits to society. Things that are costly to society are things like carbon emissions, or things like alcoholism and gambling. So we place a value on those global societal costs and then identify the extent to which the companies that are held in a portfolio are contributing positively or negatively. So you can see what is your overall societal impact score. So that's one side of understanding the impact that companies have on society, but it doesn't really help us understand the extent to which the portfolio is solving some of those very significant sustainability challenges that we're facing. And we just heard from Sheila about the focus on water. So to what extent are the companies that are being held in a portfolio contributing positively to sustainability challenges? And again, we're using the UN SDGs as a framework to help identify the types of challenges that a company may be helping to solve or negatively contributing towards. So, for example, if you're a renewable energy company, you will be having a very positive impact on climate change. So we can, through that lens, we can identify not only what is the cost or the benefit that your companies have on broad society, but also specifically what are the UN SDGs that you are positively contributing towards with your investments. And we think that's the sort of beginning of a full toolkit that will help clients understand the sustainability of their investments.
Thank you, Hannah. That was very insightful, and I think everyone is going to find our conversation today extremely useful. I'm going to wrap us up, and I would like to thank you both for your time today. I know we're all very busy, so we really appreciate you coming to join us, and thank you for tuning in, everyone.
Thank you very much.
We out.
Thank you. Bye-bye.
Bye.